Readiness of ENNIS Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial. Our mission here on this podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, protecting that value actually too. And if we're planning your eventual exit from the business, we want to help you build a business that can be transferred successfully and then help you exit eventually with success. A buy-sell agreement. A buy-sell agreement directs owners and stakeholders when the transition of ownership, the transition of an ownership interest in the business is in question. In the case of multiple owner business with multiple owners, a buy-sell agreement can be the most critical business planning document those owners have in place. These agreements can effectively minimize uncertainty and indecision during some very challenging and emotional trigger events, such as the permanent incapacity or disability of one of the owners or premature death of one of those owners. However, it's not enough to just have an agreement. It needs to be skillfully written, and it's going to need to be funded, if you will, with one of these methods, either with cash, which would be cash from cash flow from the business or reserves. Maybe the business is going to take out a loan. That's another method to fund it. An installment sale can be a method of funding. And then the most common method would be the use of insurance. And an often overlooked risk in funding a buy-sell agreement is the permanent disability or incapacity of the business owners. We often talk about life insurance. Owners get that pretty much right away, the trigger event of a premature death. However, what's often overlooked and actually is more likely to happen is the permanent incapacity or disability of one of those owners. And so that's our topic for today. An often overlooked risk in funding buy-sell agreements, disability buyout. And our guest is our friend and strategic partner, Mark Gage of Northeast Brokerage. Mark, he's worked in the industry for over 30 years. He's very skilled and knowledgeable in succession planning, estate planning, life contract analysis, and impaired risk underwriting. Strong business development professional with a CLU from the American College. And then he gives back to the community. He's an active scout leader, youth leader, very active in his local church leadership. He advises and consults insurance agents and their clients in finding solutions using life, disability, and long-term care coverage. And he represents over 30 different insurance carriers. So we're just excited to have him with us to talk about this, as he's got much knowledge and experience with it. This very important, often overlooked topic. Mark, welcome to the podcast. It's good to have you with us today.
Great to be with you today. Thank you for including me.
You're welcome.
Hey, Mark, before we get into the details regarding specifically the disability buyout, can you just tell for our listeners, just generally, why is insurance the optimal way to fund a buy-sell agreement?
Well, whether it's life insurance or disability insurance, it brings liquidity to a devastating situation. When a business owner is lost from death, they usually have had critical roles that they've played in the business, and trying to navigate that loss is challenging enough, let alone trying to come up with the money to pay their heirs for their interest in the business. Same thing happens if a disabling event happens. The business owners that are left have got to pick up the pieces, handle all the duties that were done by that individual, maybe risk with some key accounts that individual handled. And the disability buyout, after a year's period of time, facilitates bringing liquidity to that event so that the business can continue focusing on growing, and the individual who is disabled or passed has the value for their interest that they helped accumulate in that business to their family's benefit.
Yeah, and I think when Pat outlined like the three potential options of either having cash funding your buy sell or going to the bank or having insurance, in my mind, if this gets triggered, it's unexpected. So chances are the company hasn't been squirreling away the cash to satisfy the buy sell. And then if they have to go to a bank, I mean, getting a loan for a company that has just lost a key person can definitely be problematic. Um, so yeah, I understand what you're saying. The liquidity that insurance provides is just really critical.
Yeah, it's the least expensive option. Certainly if you've got to go come up with spending your cash on buying someone out, you are maintaining that cash because you wanted to grow the business in different ways. So now you're restricting the growth for the surviving partners. Um, if you've taken the money from the bank, you're still paying on a note. You're again restricting growth for the surviving partners. So, we spend our time and energy developing businesses and creating plans for businesses. And for many individuals, this is our largest asset. And to think that if we're getting close to the finish line and something unexpectedly happens to a key individual within that business, uh, our exit strategy is upside down. So it's absolutely critical that it be addressed. I try to get businesses to do it when they're first being formed. And unfortunately, a lot of times what I see is businesses will set up an operating agreement when they first form, and it has a line or two in it about succession planning, about buyout, etc. But it's not a true bona fide buy-sell agreement. It's just a couple of clauses within an operating agreement. And I've always been amazed by the number of businesses that we interact with that don't have one, or hasn't been addressed in 10 or 15 years, hasn't taken into consideration some of the tax changes that have occurred in succession planning in the last few years. So it's really a critical operation part of any business to be reviewed and to be updated and to be funded.
Yeah, well, that's a great point. Let's just put a exclamation point on it. If you've not looked at your buy-sell agreement, often we run into this where it hasn't been looked at, if there's one in place at all, apart from the operating agreement or it's included in. Oftentimes it hasn't been reviewed and looked at since it was drafted. And so hence it doesn't represent the owner's goals and objectives. Each owner, their goals and objectives on a personal level may have changed over that period of time, and it's not reflected in what the buy-sell agreement now states because it's outdated. So review your buy-sell agreement if you haven't done it recently. Hey, Mark. Okay, question number 2: why is disability often considered the silent risk? Why is it often overlooked in buy-sell planning?
Well, I think the easiest path for most business owners is to address the life insurance. I think most individuals see that as a risk. The disabling event, there's maybe some denial that could ever happen to me. And so the consequences of that just as devastating as a death for any business, but it's often the second thing that's addressed, or not addressed at all. And when you look at a buy-sell agreement, a lot of times there's language that's in there that talks about the disabling event and what the obligations of the company are, and they're usually consistent with what they are if somebody dies.
Mm-hmm.
Except you've got a window usually of 1 year of being disabled before it triggers.
Mm-hmm.
But yet the funding of it just isn't done as often. Some businesses are not able to do it if their owners are, in labor intensive occupations. But for business owners that are more in the white collar space, that are,
Mm-hmm.
the professionals that aren't engaged in labor, they can definitely secure buy sell protection, usually if they're 60 or under.
Is the underwriting more stringent for the disability buyout than for life insurance?
Both disability and life insurance are financially underwritten as well as medically underwritten. Because there are more events that will cause you to become disabled than to die. The disability insurance does have a finer, analysis by the underwriters as to whether somebody's going to be accepted or whether there's a particular part of their history that might be excluded. Somebody had a back injury 2 years ago and they missed 3 weeks of work. No disability insurance company is going to include that history for coverages. Now, that doesn't mean that in 4 or 5 years they might not re-examine it and consider bringing it back in. But if you look real closely at the exclusion, if there's a lot of times a trauma situation, so somebody has a catastrophic accident or some type of a disabling event there, you'd still have coverage even if part of the issue that they're disabled is their back.
Yeah, and the premiums, and you and I were talking about this prior, the cost is going to be higher, if you will, than life insurance typically, because statistically, disability is more likely to happen than death.
About 3 times as much, yes.
Three times as much.
Yeah, and it depends on the age of the individual, as to where they are relative to retirement age. But yeah, overall, it's about 3 times more likely that a disabling event occurs. And some disabling events are short-term in nature. And if I own a business and I'm out for 6 or 8 weeks, I don't want my shares to have to be forced to be sold. But if it's a catastrophic situation where you're out for the rest of your working years, it's critical that you have the insurance there and the liquidity for it. And your language in your agreement, as you pointed out earlier, is critical as to how it addresses this. Is the value frozen at the time of the disabling event? Is it frozen at the 1-year anniversary of the disabling event? The valuation of the business, how is that determined within the agreement itself? So all of that's tied together. And the way the agreements are written really ties directly to how the insurance is created. And maybe I'll expand on that a little bit. If you have an agreement that says if the 3 of us are partners and I go down, the business retires my shares in a redemption agreement, then the insurance policies need to be structured in the same format. If the buy-sell agreement says it's a cross purchase and the 2 of you are both owning coverage on me and I own coverage on both of you, then again, I have to structure the insurance policies to be owned in that same manner. And a lot of insurance professionals that don't live in this space often have a disconnect between the ownership of the policies and what the agreements were written. And, I've had some horror stories that I've run into before where I've helped businesses and their insurance person didn't set up the policies in the right format and it conflicted with what the agreement was. I even had one business that had 3 owners, and one of the owners says, I've got a person who's handling my insurance. He went off and did it by himself. He passed away 2.5 years later. $5 million came into his wife for the value of his business. His wife then hired an attorney and said, listen, I still want my $5 million for the value of my husband's stock. She had already gotten the $5 million, but the policy was set up and structured with personal ownership. Wife is the beneficiary. And the attorney's like, well, she should still get $5 million more for the business because, that was a personal policy. Yet the design clearly was being a business policy. And all of them have been bonus monies from the business to pay the premiums. So structure and design can be absolutely critical with the insurance space.
Yeah, well, she had a strong case there.
Yeah, I think so.
I imagine
Mark, are trusts ever part of the planning or no? Like insurance trusts or anything?
I see that more and more now where the attorneys will put together an agreement and they'll ask for a trustee buy-sell agreement. So yes, that could come into play. Depends on the number of owners that you've got and the business structure, meaning the tax structure of the business.
Hmm. Yeah. Whereas maybe, well, I don't want to go down that road. It's going to get too technical and it's going to get off topic here. So let's just review again too, though. What would be the consequences for an owner if they become disabled and there indeed is no permanently disabled, not short term, but permanently, and there is no disability buyout coverage in place? What are going to be the consequences? Let's walk through that so that folks are clear.
Well, you've got an individual who's now out of work. Their livelihood was the business. So first, does the business have an obligation to continue to pay them a salary? And if so, for how long? So you run into that conflict that's there. Secondly, that business owner has got a financial interest in the business itself, the stock that they are possessing, and probably wants to have that stock be liquid. And frankly, is now also at risk that if he or she was critical to the operation and the business doesn't survive that disabling event, not even being able to get the full value of their stock from the business.
Mm-hmm.
Versus if it was funded with proper insurance, the family no longer has to worry about are these two knuckleheads going to survive me and keep the business afloat, or is it going to tank, which
Mm-hmm.
we've seen happen umpteen times with certain individuals that go down within a business. So
Well,
consequences
that's
could be
that's a
huge.
good point too. That's a very important point because not only the business is going to be impacted, the sustainability of it, the growth of it, future of the business is going to be impacted if that partner was still making a significant contribution to the day-to-day operation and success of the business because their skills, talents, institutional knowledge, maybe relationships with customers, vendors, suppliers, long list, is now gone. And so, and not available any longer for that business. So that's going to have impact on the future growth, but also the current valuation. And just so that's a very important point. Thanks for mentioning that.
Absolutely.
Yeah, and so if those consequences in that event, and there's not the liquidity coming into the situation from insurance coverage, they'd have to go back to one of those other three options. They'd either have to have cash on hand from cash reserves or cash flow to facilitate the transaction, or they'd have to go to the bank, get a loan, and or go to the bank, get a loan, and or do an installment loan with the disabled to pay the disabled owner. And
All
then,
three of which are negative energy in the attempt to grow a business, right?
yeah, exactly. Right. So you got that negative energy on top of the fact that all the gifts and talents of that partner are no longer there. And then there can be
Yeah, I think
negative
when
energy and strained relationships as well, right?
you can have business partners that have been in business together for 20, 25 years and something happens and, you know, financial pressures can create real hardships in individuals as well as the business itself. I think ultimately you have to remember you're creating a financial conflict between the surviving business owners and either the family or the individual who's disabled and what they want and what they need. So the surviving business owners want to pay the least amount of money out the door possible because they're worried about keeping the doors open long term. And the family's worried about getting the most amount of money that they possibly can out of the business from an income perspective and for the value that they helped build in that business all those years. So you have an inevitable conflict, and that hopefully that buy-sell agreement articulates exactly what happens in the valuation of that business and
Mm-hmm.
how it's all supposed to play out. And when the insurance funds it appropriately, it works well. But as we discussed before, so many times people set up a buy-sell agreement or operating agreement, they throw it in the can, and their business has grown by multiples. And they bought an insurance policy, if they got one at all. They bought it when their business worth is a quarter of what it's worth today. And so the other 3/4 that's bare, meaning it's not covered with insurance, your recourse is those 3 points that you just mentioned a minute ago, because it's not funded fully enough in relation to the current value of the business. And so it's important. I tell people, whenever you're doing your tax returns every year, that should be an annual trigger event for you to say, let's pull this out. What's our value worth now? Pay the money to have a professional evaluation done, because you can't just pull these numbers out of the hat. And the more conservative approach would be to have an addendum to your buy-sell agreement that actually redefines every single year, this is what we all agreed upon.
Mm-hmm.
So it buttons it up as much as you possibly can.
Yeah, our experience has been when there has been conflict that it regarding the buy-sell agreement, um, that's been neglected and not reviewed, is the conflict more often than not happens because of the lack of clarity regarding the valuation method. And it's, yeah. So anyway, great point. Walter, any other questions from you?
Just going to ask one question. So, Mark, you talked about having having it structured as a redemption by the company versus a cross purchase. I mean, is the general rule once you have more than like 3 people involved, you go the redemption route, or do you always like the redemption route, or is there really no rule of thumb?
I think you got to look at each business individually. There was a Supreme Court case a year and a half ago called the Connolly case that really has
Mm-hmm.
thrown that world upside down with redemption agreements.
Mm-hmm.
And so we see often a trustee agreement that will give the ability to do a cross purchase. And we see more and more situations where a cross purchase is the first way to address it, even if it requires, dealing with multiple ways to cover the risks. So it really, from a tax perspective, can be a big difference. If you look at the current way that lawsuit and the settlement by the Supreme Court, I mean, they unanimously said the life insurance proceeds that come in for a buyout can be counted to increase the value of the business.
Mm-hmm.
So you have a $10 million business and 3 partners that all had $3 million come in, and now the death occurs and $3 million in life insurance comes in, and now the business is worth 13 million, but I only had coverage to buy 3 million of my interest, and now I'm short because of that. So the planning is really critical, and again, it comes back to ownership structures, designs,
Mm-hmm.
thinking through the pros and cons and all these different types of things. It's a lot more work for me with multiple owners doing an awful lot more insurance policies, but if that saves millions of dollars in tax liability, it's worth that effort, right?
Mm-hmm. All right. Excellent. Any other final thoughts, Mark, as we wrap up? Or um, like if three, we like to give 3 action items if you can. If you were going to speak to the listeners directly and say, take these 3 actions, what would they be?
Well, first I'd find out, do I have a legitimate buy-sell agreement, or is just a part of my operating agreement?
Mm-hmm.
Secondly, when's the last time it was reviewed in
Mm-hmm.
relation to the tax law changes that are just a year and a half ago?
Mm-hmm.
And third, is it funded?
Mm-hmm.
If it's not funded, have you ever looked at getting it funded with,
Mm-hmm.
disability, buyout coverage, or life insurance that would deal with those issues? And the funding really comes into play too, whether you've got some, is it enough relative to the current value of the business?
Mm-hmm. Yeah. So then, if there's a listener that would like to talk to you directly about any one of those 3 things, how can they contact you? They can contact us, and we can.
Yes, certainly through you. My email is mgage at n like new, b like business, hyphen bga, boygirlapple.com. So mgage, Gage, at nb-bga.com. And my phone number is 410-552-9300.
Yeah. So, listeners, please take those 3 steps. If you have not done it recently within the last year or two, please consider doing it. And you can reach out to us or Mark and for help with that. And if you want help, listeners, in maximizing with any of what we've talked about here today, or maximizing the value of your business, um, planning that eventual exit, and in life after the business as well, you can contact us at ENNIS Legacy Partners through our website, ennislp.com or ExitReadiness.com. Both get you there. Thank you again for listening. If you've benefited from today's episode, please consider liking it, sharing it on social media. And until next time, when the Exit Readiness Podcast, this is Pat Ennis and Walter Dial signing off.